My guest on the interview today, Swanand Kelkar from Morgan Stanley Investment Management. Swanand, great to have you in the studio. You've been in the hiatus for almost a year now. What kept you away from the camera?
The markets. But jokes apart, I mean, yeah, so it's been really tough.
It's been a tricky market.
Yeah, it's been a really tricky market. Yeah. You need to have something to say for you to come on and say something on this kind of a show.
So there couldn't be a better time than right now. You don't know which topic to pick up, whether to start from the glow, whether to look at internals, to talk about NBFC. What worries you right now about the market? Let's start with the worries first.
So I would say there are two axes, there are two broad axes of worries today. One is the consumer slowdown, and that's been talked about quite a lot. So if you look at a lot of the high frequency indicators which keep coming out on a monthly basis, a lot of them on the consumption side are slowing down. I think that's worry number one. And second, as you mentioned, is the NBFC situation. And these two at some level are interlinked. They are not totally independent of each other. I think the second worry is on the NBFC side, that how does this situation, how long does it go on, what are the kind of impact implications it's going to have, how does it resolve itself. So I think those are the two broad buckets of worries that we have at the moment. But at the same time, we always tend to focus on what are the current worries in the market. I think we should also spend some time thinking about what are not worries at this point in time, which were, let's say, 12, 18 months ago. So the external side of things looks pretty okay. If you look at the current account deficit, I think we are headed towards a 2.5, which is a manageable number in the Indian context. A year ago, this was a hot button issue when crude was at, not even a year ago, maybe in October when crude was at 80 odd. People were thinking, where is the current account deficit going to, how is it going to get funded, is the currency going to take a knock? I think that's not so much of a worry right now. The fiscal deficit, though challenged in the sense of having some room to do things, is not a big worry today in terms of whether it is blowing out of.
But it's challenging nonetheless.
It's challenging.
Yeah.
It does not have a lot of headroom for you to do things, but it's not a full blown worry. And there is a worry on the other side of things, which I feel is how inflation has undershot what the RBI's target is, or their forecasts have been. So if you think about the four broad variables, right? I mean, my friend Niranjan Rajadhyaksha at IDFC Institute, he has a great framework for this. He calls it the 2-4-6-8 framework. And if you think about the four macro indicators that matter for India, which is to have a current account deficit at 2%, inflation at 4%, combined fiscal deficit at 6%, and growth at 8%. If we achieve all four, that's the holy grail of Indian macroeconomics.
That's the utopian situation.
Exactly. I think it's the 8%, which is the growth number today, which is the main worry. If you think about the past 5 or even 10 years, at different points in time, one or two of these four variables has been your main point of discussion at that point in time, right? It's either inflation, it's either a current account deficit, fiscal deficit, or growth. In 2013, Fragile 5, it was all about the current account, the twin deficits, right? Growth was fairly okay. So this time around, the last 8%, the growth number is what's under discussion. You would say fiscal deficit not flashing red, but not much space to do stuff. And the external side, which is inflation and so the current account deficit and the inflation are fairly well managed. This time around on the growth slowdown, unlike the earlier growth slowdown episodes, you cannot point your finger at one thing, right? In demonetization, you could point it at, let's say, demonetization happened, hence growth slowdown for the next 3-4 months.
Or the teething troubles with GST implementation.
Exactly.
Yeah.
This time around, let's say starting August, September of last year, growth started slowing down, especially on the high frequency indicators. To start with, it was concentrated on the auto side of things, where you thought that this is more a localized issue. You had a natural calamity in Kerala, you had insurance increases for the auto sector, then you had the liquidity, the NBFC crisis come through. So it's just a confluence of a lot of things coming together, which has caused this growth slowdown, which is why if you ask anybody, nobody will be able to give a very precise answer on why has growth slowed down, which by corollary means that you also won't get a very precise answer on what's going to make it snap back, right? So let's say if you think about demonetization, people were watching cash in circulation as a good leading indicator to tell you when the economy or the consumption side normalizes, right? But today we are playing it by the year. We don't know when things will come back.
You don't know the cause, you don't know the indicator.
You have a sense of the cause that's more backfitted, where you have said that, okay, these might be the confluence of 4 or 5 things which have caused the consumption to slow down, because even on the consumer side, the picture is not very clear, right? The balance sheet of the consumer looks okay. If you look at some of the asset quality numbers on the retail side or the consumer credit side, those aren't flashing any signs of concern at all. I mean, we get data from CIBIL, which you can look at on a quarterly basis. That's doing fine. If you look at the income growth numbers, be it rural wage growth or as an urban proxy, the BSE 500 employee cost growth, that's not doing anything too different from what it has been doing, let's say, for the 3-4 years. So I think the consumer related issue has got more to do with sentiment, or what Keynes calls animal spirits, rather than your balance sheet not being able to take things, or you not having the wherewithal to spend money, because these things don't change overnight, right? I mean, it's almost as if demand has come off in a big way. Having said that, on the consumer side, the one more, or in general, the other point that I would make is that YOY numbers in India have become a bit deceptive just on a YOY basis, because there have been so many things in the base which have kept going up and down. You had demonetization to start with, there was a GST rollout, there was GST amendments, a big amendment which happened in I think November 2017, and you had these changes for autos, they had a BS4 transition. So my cautionary thing to everybody is, don't look at YOY numbers on anything. You would rather look at a 2-year or a 3-year CAGR for most things, right? Demonetization happened in late 2016. So if you look at a 3-year CAGR number today, it will give you a good sense of how deep is the growth slowdown. It might not be as bad as the YOY number suggests, and that's true with GDP as well.
You're ruling out that this is a structural issue to begin with.
It's very difficult to call this a structural issue at 18 cars per thousand, right? If at this level of penetration, if at this level of economic growth, and as I said, right, the consumer balance sheet, consumer income numbers don't flash any red. It's very difficult to conclude that this is a structural issue, unless of course there is something out there that we can't, I mean, that we are not aware of.
Yeah.
There's some fundamental changes happening. I mean, I saw an interesting data coming out of the US that a lot of the 21-year-olds don't want to have a driving license these days.
Yes.
But that shift didn't happen between August and September of 2018, right? It did not overnight people shunned driving licenses. It's a very slow change. I mean, that is a change which will happen over the next 10-20 years, possibly, where owning
the next gen wants to be very conscientious and go for Uber pools and not own cars.
Sure, or maybe doesn't have the same affinity to creating a balance sheet like you and me. I mean, you care about owning a car.
You. I don't own a car.
Or okay, let's generalize this. People care about owning a car, people care about owning a house, people care about owning a jewelry, or some jewelry at least. And if you look at people who are in their 20s, none of this holds any
value to
appeal to them.
But are the prices absorbing all the negative? Are they done with the downtake and the damage, and now will they just stagnate at the current levels? Because you've got most of these stocks already making 52-week lows, barring maybe Bajaj Auto. Is the damage in the price?
So I think what's happened is, as the monthly volume numbers have broadly stabilized, not on a year-on-year basis, but just on a sequential basis.
Month on month, yeah.
So have the stock prices, right? Especially on the auto side. I think it's a more a wait and watch approach that now markets are taking, and even auto manufacturers are also saying the same thing, that okay, we are hoping for a good festive season, we are hoping that there is some kind of a pre-buying, and that's what I think the markets will do. As I said, nobody is extremely clear on why this slowdown has happened, which is why it is very difficult to tell you what will snap us out of it. So it's kind of becoming a play by the year. But stock price, as you rightly notice, I mean, they seem to have stabilized at a certain level, and I think what will take them up is that you get a print, you get a monthly volume print for 2-3 months, which at least level wise is higher than the last month. And that's what will revive the
And that's what investors should look at if they're looking to buy these dips.
I would think so, because we are, in that sense, as I said, there is a margin headwind as well, right? This is not just about volumes. You are now going to transition to BS6 for most things, which is going to be non-trivial on costs for most things. I mean, 10% plus for commercial vehicles, for two-wheelers, a similar number. And given the experience of the past 10 months, I don't think manufacturers are going to pass on the whole thing. I think they are going to...
And they're going to incur big capex costs.
Exactly. Capex is one, and whatever cost they are incurring to meet with the BS6 norms, I don't think all of it going to get passed to the consumer, which means you have some margin challenges as well. So I think that's what you will have to look for if you want to invest in auto stocks. Or the thing which a lot of portfolio managers do or end up doing is what I call one day, someday stocks, right? That you
One day, someday.
Yeah, so it basically means you have a stock in your portfolio, you cannot tell when growth is going to come back, you cannot give you a path to growth or a path to recovery.
But someday it will.
One day, someday, it's got the basic building blocks in place. A lot of auto stocks would fall in that bucket, right? It's got the basic building blocks in place, market shares are protected, ROEs are good, currently going through a cyclical slowdown, I'm convinced it's not structural. Tell me how growth will come back, no answer. Tell me when will growth come back, no answer. But these are the one day, someday stocks.
Right? That's an interesting one.
But a one day, someday can only be a limited part of your portfolio. You cannot run an entire portfolio with
high risk, high
with one day,
return,
someday stocks. That I cannot tell you in the next 12 months, these are the things that are going to change.
But someday they may. Hold on to that thought. Lots more to talk about. We're going to take a very quick break. We've discussed consumption briefly, but lots more to discuss. Come right back. Still in conversation with Swanand Kelkar on the interview. Before the break, we were talking about autos, we talked about a consumption at large and whether the domestic internals along with the global fundamentals are really rocking the boat for us. But Swanand, you know, we've got to talk about the elephant in the room, this entire liquidity crisis, which is more a confidence crisis. Most people say that. Are we anywhere out of the woods, or do you think this is just the tip of the iceberg?
So it's difficult to time these
events.
And this is a start, middle, and end. But if you look at just the market cues, right? There's been enough talk on how we reached here, what's happened, what triggered what's been the what's actually happened. But if you look at what the market is telling you, it's already started separating the men and the boys.
Sure.
Even within the NBFCs, there are stocks which are at probably lifetime highs. Bond markets or fixed income markets are giving them money very easily. There seems to be no crisis there whatsoever. There is the other end of the spectrum where you have really no idea on
what's in the books.
What's in the book. You're just very cautious on that part. You really don't know. Let's call them boys there. So there is men here, there is boys, and I think there is a fairly large number of NBFCs which are in the middle today. You can call them young adults if you want.
What constitutes this pool of young adults? What all constitutes rather?
So there will be a lot of companies in this pool where you can say that they have a reasonable asset side niche, wherein they have a reasonable asset side niche where they're lending into spaces which gives them good yields for whatever reason. The competition obviously is coming down there. Most of them you look for have a strong parentage, wherein you have a liquidity tap, or you can tap into the liquidity of some of the parentage that you have. And you have a business model which is basically humming or doing well. What you have done in the past 6 to 12 months on these NBFCs is that you have probably kept liquidity on your balance sheet in anticipation of the ALM challenges that you are having, which means that your NIMs go down, your growth comes off. So if you can look through this period, and I'm saying 12 months just tentatively, it may be more than that, but if you can look through this period of lower growth, lower profitability, I think the markets are pricing this in, at least for some of them, right? That you are going through lower growth, lower profitability phase. But I think if these NBFCs survive, and I think some of them will, it's not going to be just 3 NBFCs in the country. I think there's good money to be made over a 3 to 5 year time frame on these.
You know, since corporate banks are the fad, without taking any names, they are the most sought after names on D Street, and you know, because they've managed to withstand the market volatility and mood, etc. as well. Have they made it to the grown-ups, or are they still young adults?
Yeah, so the young adults analogy is more for the NBFCs, but I would say on the banking side, and that I think is a positive which has happened over the past maybe 12 to 18 months, that from an institutional investor portfolio, maybe I would say 12 to 18 months ago, there were only 4 investable banks, 4 investable large banks in India. That universe has expanded, right? You now have probably a couple more which you can add, and so that theme is playing out. I think there is only one metric that you need to track there, that are slippages in control, that you are not seeing a second asset quality cycle just as you are coming out of one. For now, the view there is that you might get a small hiccup there, but it's nowhere as close to what you saw in the past. So I think that theme continues. That I would say on a large cap, big companies basis, that's the only theme in play in the markets. You can see that in the ownership of some of these stocks. Apart from that, there are places where there are market share gains, right? In an overall growth which is sluggish, there is formalization which is playing out. If you ask any FMCG company, they'll tell you that modern retail's salience in their sales has gone up multifold. So modern retail is now contributing much higher to their sales, and this happened after demonetization started there. So modern retail is doing well, even within an overall consumer which is slowing. There's a share gain for the modern retail. There are share gains happening in categories like jewelry or even QSR. Which have been helped by some other factors as well. So isolated, you can find a few spots of growth and ROE here and there, but consumption, which was bulletproof, which was the bulwark of a lot of portfolios for the past many years, incrementally what we have done is moved our portfolios over the last 6 months away from consumption more into the investment side of the economy, right? So that's the big, if you ask me what has been the overarching theme within the trades that we have done in the past 6 odd months, that's been the thing. We have sold out of some of the consumption names and bought into some of the investment related names, and correspondingly if savings investment identity holds at a fixed current account deficit, that also means that your domestic savings have to go up.
So when you say investments, what kind of companies do you put money in?
That would be things like E&C companies, engineering construction companies. Cement is always a good play on the overall space, and if you find niches where a lot of work is happening, there could be the metro constructions, there could be T&D, transmission and distribution, where at least the workflow seems robust, the order inflow seems robust. I think those are some of the spaces that you can.
But again, stick with the top guys, or would you try and look some of the bottom-up stories as well, wherein there is hope of business coming in?
Yeah, so I would say in that space specifically, you are seeing you are able to invest in current growth, which means you are seeing order inflows grow at 15%, 20%, which will eventually translate into P&L. So you are seeing actual real growth here. These are not the one day someday kind of stocks.
Yeah.
So that is where we have reoriented portfolios to. We have engaged, after staying away from the sector for a long time, we have engaged in life insurance over the past 6 odd months. So yeah, incrementally that's been the theme in the portfolio.
The other leg of consumption has been staples, pure play FMCG, and again it's been a very spotty growth. I mean, you don't know what to do because you know these are businesses, you will always need your soap, you'll always need your detergent and toothpaste, but again you don't know which out of the names to pick out. Would you say that best stay away from these names also right now because of various parameters, or would you say keep it, forget them, someday you will be in the green?
So on the FMCG side, I have been more valuation conscious than anything else. So I haven't been able to pay up 50, 55 Ps on most of the things. But that's just me as an investor. That hasn't stopped a lot of these companies from doing well all through 2017 and most of 2018. What's also happened is bulk of the FMCG companies have had this windfall from a GST cut, right? Which is why volume growth, which was 5-6% for a long time for some of these, suddenly shot up to double digit over the past 3-4 quarters. That I don't think it's sustainable. I think it will revert back to its earlier mean.
As a theme, since you're a long-term guy, where do you see disruption coming in? I know you've talked about moving away from consumption to investment, but what could be that big disruption wherein you could see many-fold ideas propping up?
So I think
as a trend,
it's very difficult to put a finger on what disruptions could come and what could be interesting. But you know, sectors which are more prone to getting disrupted, right? Media is one, right? You don't know how your viewing habits change, what you do.
Nothing's changed. Eventually. People still go to movie theaters. PVR INOX is still doing well, irrespective of the exorbitant popcorn prices.
Sure, but you're also now spending a lot of your time on the
OTT
platforms, and that has proliferated a lot. Your expectation from what you want to see in a movie has also changed quite a bit. What I worry about on the multiplexes side, and I haven't seen the recent data on it, the ticket sales growth in India hasn't been great.
That's because movies have been pathetic.
And pricing.
Yeah.
And obviously pricing has been at such a level that you're not getting any real growth in your ticket sales, which worries you, right? And any industry which relies solely on pricing,
content and pricing, yeah,
solely on pricing to get its top line growth, it's something that you worry about. I mean, till how long can this last? So that's one. I think autos is something which will see a lot of changes. I don't want to call them disruptions, probably an abused word, but there will be a lot of technological changes which will happen on the personal mobility transportation side over the next few years. There's a push more towards a cleaner environment, etc. I think those things are amenable to disruption. There are no direct plays in India, but one thing that I'm trying to come to grips with is gaming. A lot of the millennials spend inordinate amount of time playing Fortnite.
Guilty as charged. Not a millennial, but still.
So I don't know. So a friend of mine told me that DJ Marshmello had a concert inside Fortnite and it was attended by some 20 million. As an investor, I worry about this. I cannot wrap my head around how this happens. I don't understand this concept at all. So I think these are some of the changes where how you are spending your time getting yourself entertained. If you think about that as a broad bucket of entertained or even educated, I think that is a space I would watch for. If you ask me what are the listed plays here,
that's what I was coming to. I mean, if you draw down a list of listed names, you don't have any option.
There is nothing much here. But a thing which I find I like to track the media space. Is that the telecom players might be big beneficiaries of this explosion in platforms. Right now, let's say everybody has a platform on which you put your original content. At last count, there are more than 30 in India. Not all of them will survive. Not all of them will have a business model to attract the kind of revenues to create that content. So what ends up happening is that the aggregators or the telecom operators, they become the aggregators of all this content, right? And it's available to you as a pack when you pay for your mobile phones.
But there'll always be someone who is cash rich or who's willing to, draw down on the profits and will give you data cheaper, and you'll take a second to switch over.
Sure, absolutely.
So, I mean,
that's true.
What's the winning game?
No, I'm saying what's happened is that the telcos as a group, right, will become aggregators of OTTs. You can only have a limited number of OTTs on your phone. Right? You're not going to have 30 OTTs there. But let's say you get a pick and choose on what you like.
If you buy Jio, these are the channels you get.
Exactly.
And if you buy Bharti, this is what you get.
This is what you get. I think it's a good situation for the OTT, especially the small one, to be in, because it covers some level of expenses. The deal that you have with the telecom operator, the telecom operator is able to give a bigger bundle of content to the consumer. There are a lot of apps now, one run by your sister concern as well, which are aggregating content from other people and putting it together on a single platform. That's a business model which I'm watching. Since you're talking of disruption, I'm also watching on how gamers take to games being hosted on the cloud, which does away with the need for the hardware. You don't need the controller, you don't need the box. It's all hosted on the cloud. That probably we get to see some feedback of it.
You played games ages back, it seems.
Yeah.
Okay. Lot has changed.
Really? Okay.
Yeah. We would have loved to speak more. Unfortunately, it's a half-an-hour show, but great having you on the show.
Thank you so much.
Thanks so much.